We've got all this maelstrom of what's happening geopolitically. How is that affecting your thinking overall when it comes to strategy? And what do you think it actually means ultimately for the investor?
Well, clearly, what's happening in the Middle East is heartbreaking, and our thoughts are with everyone affected. But at the same time, we have to take a more rational view on how does that impact on the global economy. And most of that is coming via, or would be coming via, the energy market. So at this point, the fact that Iran is not directly involved, and the oil supply from the region continues to be in sort of a normal environment, and we've seen oil prices staying around the $90 per barrel zone. I think the direct impact on the global economy and subsequently on the market is likely to be limited. Clearly, we hope for a more a peaceful resolution to the situation. But from an investment standpoint, we are monitoring rather than abruptly acting on these events.
Is the clear sort of expression of this going to be only contained to oil markets, you think, Tai Hui? I'm just wondering, or is there still that risk of this spreading to other asset classes?
I think there are safe haven asset classes that could potentially be supported in this environment. For example, we did see gold rise to some extent, and also treasuries. But overall, I think the Fed's policy in the very near term continues to drive how investors view asset prices. Ultimately, the November meeting that's coming up in a few weeks' time, that's going to be absolutely critical.
Tai, how does the Fed look at what's going with oil prices? I mean, it's a tax. It can be seen as a hike in interest rates. Also inflationary. It's got all the nasty elements that you could possibly wish for. But it's again something which does part of the job that the Fed wants to do, alongside, of course, what the bond market has been doing. So does this make it even more certain that they do nothing until 2024?
Well, I do think the Fed really ought to stay put, given not just what's happening in the Middle East, but also we've seen a number of risk events happening. For example, the UAW strikes in the U.S., and it's not just the auto sector, but we're seeing strikes across the country. Now, obviously, the Fed could interpret that as a source of wage inflation, which could be justifying their hawking position. But at the same time, if people are on a strike, they're not getting income, and that creates a potential dampener on consumer spending. The other risk that we've seen in the last few weeks is obviously the near government shutdown, and that the budget's been extended till the middle of November. So again, we're not completely out of the woods yet. So I think these events in isolation, they're not going to cause a recession in the U.S., but together, I think that could potentially dampen consumer and business sentiment. And the Fed, when they're making decisions, they have to take into account some of these unknown risks that could be lurking in the background in the next 6 months. So yeah, I do think the Fed makes sense to stay put for the time being.
So what's the investment advice then, Tai Hui? I mean, if basically stocks and bonds have been competing with cash for much of this year. I'm just wondering, for those that are looking to maybe deploy some of their money out of these money market funds, where should they go now?
Well, in the very, very near term, i.e. the next few weeks running up to the November FOMC, I think we do perhaps stick with the shorter duration fixed income, where they can provide high yields, but at the same time, a lower duration risk or lower volatility in the bond prices. But as we get more confirmation the Fed is done with raising interest rates, I do think this is a case for lengthening duration, moving towards the value of the curve, and also at the same time look into some of these stocks that are typically more sensitive to a falling interest rate environment. For example, in technology and growth stocks, whose valuation re-rating could potentially benefit from a decline in bond yields.